to the Risk and Roll podcast.
Hey everybody, welcome to another episode of the Risk and Roll podcast with some of your favorite characters who like to nerd out on all the stuff that most people roll their eyes at. We have Greg Oliven with Polygon Research, where he's talking HMDA data today. We've got big reports on that one. Bob Simpson with DaylightAML is bringing some interesting insights to the BOI reporting and what this may mean for us in any risk analysis. And then Ray Snytsheuvel, as always with Loan Risk Advisors, likes to just bring the charm about why what you're doing probably will get you into trouble. I'm joking. It's like it's all a risk analysis, right? And I'm Nathan Nottingham with the MLO Force, where we like to train and just do it a different way, better. And so with that, Ray, we were headlining some of these topics, and I want to start out with maybe the most timely part of this entire thing, which is that March 31, end of March, end of Q1, CFPB drops a massive amount of data. The HMDA data reports out, and Greg Oliven, with he and his partners there at Polygon Research, had to put their arms around a lot of data and are doing it quickly. So, Greg, what's happening with the HMDA data that you've been seeing come through?
Well, the first answer to your question is that there actually was data. The CFPB has a mandate to get it out by the end of March, but there's been a lot of uncertainty over there, as we all know. And we were watching, and we've talked about this before among this group, that we were seeing the weekly updates from the previous years that are still active, 22 and 23 coming out every weekend. So we were hopeful. But indeed, the HMDA Ops team came through, published it on time on the 31st itself. And we've seen that before in some earlier years. They get it out on the last day of the month. And so, yeah, we've got some initial observations. The market is a bit up. And I think we've all been seeing that in our work. But 2024 compared to 2023, so about 7% by closed originated loans, 14% by dollar volume, if you want to measure it that way. And then some of the early things we're seeing is that, Refi is up significantly, and we've seen that in our MBS data for the last several months. It's been ticking up, but HMDA confirms it as well. In aggregate, 24 Refi is up significantly, about I'll tell you the number in a minute, but that's the biggest surge across the different loan purposes was in Refi. And then as far as the types of loan, VA had a really strong year in 2024. I think that's what I was emailing you about in the middle of the night, Nathan.
Yep.
We see it up about 29% compared to 2023.
Wow.
Well, I think I saw, and you were quick. I got an email from Val almost immediately as soon as the data came out, April 1 early. You guys had written a blog. You said, hey, here's the 2024's top mortgage lenders. Here's some of the quick takeaways from all that. So your data, you guys are pivoting this almost immediately structured-wise. Is there, outside of VA lending, and well, actually, if I can lean in there, when you look at the data set there, was anything point out and go, why was VA lending higher in a market where things seem to be restrictive, both from a cost and interest rate perspective?
Yeah, we're still digging in, so I'm not sure I'll have a complete answer to that. But it is interesting to note that not only did it beat its performance in 2023, up that 29%, its market share rose as well, overall market share compared to the rest of the loans available. So we're at about 8% for 2024, where it was 6.6% market share of all the different loan types in 2023. So I am not sure what the dynamics are. Will it be drilling into the pricing, channels, who's doing VA loans, et cetera? But just up across the board are our initial observations.
It'll be really intriguing to figure out what kind of one of the driving factors behind that, the VA home loan, and what that effort was behind. So, HMDA, Ray, Bob, any insights on that too? Any thoughts about that?
Well, for me, I mean, I'm curious to see more about it. My lean is typically towards fair lending performance. So you know, has it changed? And again, Greg, it's probably too early to say on the data. You guys are like, looks like you're doing 24/7 on the data. So I don't want to be unfair. Like, how did you not hit the data I'm interested in? But, you know, come on. Greg, I did not get an email from you at 2:30 in the morning. I was waiting. So So I'm curious to see the fair lending performance and how it played out. Did it change or not? So that's going to take a little more time in slicing and dicing, I'm aware. But I look forward to seeing that and what the impact was there. It's always the case. And fair lending is often just a loan volume issue, and it's not necessarily bad actors, but I'm curious as to then, are the demographics changing insofar as the lending? If you are going to see a bump in VA, I think you might see some changes, of course, in the demographics. VA demographics are a little bit different than generally, which is great in some ways. So I'm curious to see what the effect was from that perspective. But I am curious also, one of the things we talk about in the business, and Greg, I wonder if you saw that in the data, you mentioned refis were up substantially. It sounds like. I mean, I think by numbers it wasn't as huge as we saw in 2021, but I think that it was up. But then, what does that mean for purchase money? Anything that you've seen there? I mean, by volume, is it any different? I would say by percentage it might be different if refi is up. But more importantly, is the volume the same as it was in 2023, or what do you think?
Yeah, I'll give you a couple of perspectives. That number I was looking for earlier was refi was up 60%. This is by closed loans, by units, in 2024 compared to 2023. But purchase was up too, a little bit, almost 2%. But then when we look at 2024 itself and sort of the balance of the market, we see that purchase was about 57% of all the different, purposes for loans. And refi has just about caught up to cash out refi, which has been strong the last couple of years. So cash out refi is 12.5%, and refi itself, rate and term refi at 11.3. But to your point, if we flip that over to dollar volume, it changes. Now we've got purchase at about 67%, and refi is in number 2 at just shy of 15%.
Okay. No, that's the purchase money. That's what we're trying to find out as to when is the market going to move. I think in some cases, and again, this is not my space, Nathan, you know better than I, but how is the market moving? No, I'm just the reg guy in the background, so we're always curious about the volume. So good to know.
Mm-hmm.
I'm interested to see when we can pivot that data with Polygon's dashboards, your HMDA Insight dashboard too, because I think that we've worked together with my other organization, VA, quite a bit. And I think that one of the things that I've seen in the VA lending, but also seeing across with more awareness, and this is to your point, Ray, with fair lending, is that the VA loan as a whole is more fair, regardless of ECOA, fair housing, all the restrictive, like you can't judge or discriminate based on all these things. The VA loan basically comes in and says, hey, we will handle everybody. We've got no cap if you've got total availability in your COE and eligibility is wide open. There's no cap. You're getting 1.5, $2-3 million loan amounts at 100% financing, as long as you can afford it, right? So your ATRs and your QMs still apply, of course. Well, I think that message is getting out there. And so it'll be interesting to see now on the refi take. With interest rates the way they are on credit cards and other when you're facing inflation, you face the interest rates that are going up. I know from operations standpoint, where I'm in a brokerage watching this stuff, we're seeing people come in and go, hey, I've got a lot of equity. I don't want to touch this interest rate I got in 21 or 20. I really want to get some of this equity. So they're looking at HELOCs, or they're saying, you know what? I can't do 29% and I can't do 10% of my car loan. I'd rather take 6.5% onto my mortgage and just get all these things consolidated. So I could see us hitting another refi boom. Not boom. That's the wrong word. Some refi movement in 25 as well. Now, if rates hit 5%, watch out. I think you are going to hit a boom, but that's my take there on the ops side. From a AML BSA, I think, Bob, when you look at some of these contexts of where the market's going and what we're seeing with rates and structure, what kind of risk are we considering when it comes to BSA and AML structures here?
I think we underestimate how much money laundering goes on in real estate. I got in this week and was looking at some things I normally don't look at because of this interim rule that is just proposed by the Treasury Department to not enforce the beneficial ownership interest information on U.S. companies. We're only going to make you declare who owns your company if you're a foreign company. So I wanted to get in and kind of look at this issue and do a little deeper dive on it. So there's an organization called Transparency International. They're at transparency.org, and they give a money laundering scorecard to all the different countries, and they evaluate the quality of your anti-money laundering framework, and very interestingly, the ease with which people can find who owns properties. Topping the list of somebody who does it really well is England and Wales. Every property is transferred, and it's done on a public database. It's free to access. You can find out who bought anything and sold anything, and you know who all the actors are. England and Wales, they get a gold star. The bottom of the barrel, oddly enough, was Australia and China. China maybe not so strange. Oh, the other one at the top, doing it super well, South Africa. You can find out who just bought and sold properties with very limited roadblocks. Okay, no cost. A couple of nations, France has a really good system, but they charge you to access it. Okay. Well, the U.S. is kind of in the bottom quartile of everybody's valuations of what we do to prevent money laundering. And then with this week it coming out that we're not going to play in the beneficial owners space, declaring who buys and sells properties. When I got in and looked at it, beneficial ownership information is like the number one thing other nations are concerned about. Don't let Russian oligarchs buy my properties, snap up, high-end Paris, London apartments, and do it anonymously. Everybody's concerned about it, but not us. So we're short busing this. We are not the head of our class in anti-money laundering, and we really hurt ourselves this week. Here's why I'm concerned about this, and I'm not going political. I'm going practical. Mm-hmm. Let me talk about Grand Cayman. Okay, Grand Cayman for years had that reputation of being able to fly into GCM with a bag of cash. You could go into Georgetown and just bring in your duffel bag, and Cayman was okay with that. Then they really got their act together because they're a British protectorate, and they really got their act together and tightened up, and they were really proud of their reputation down there, how much they were fighting money laundering. Well, they screwed up, and they ended up back on the gray list. They ended up back on the gray list. You needed to tighten up, and it took them 3 years to fight their way back to get off the gray list. Well, what is that gray list? The gray list says that we're going to limit the amount of financial transactions, and we're going to watch very closely the amount of financial transactions that go into Cayman. I say all that to say, when the U.S. makes decisions that make us look non-prudent when it comes to money laundering, that can have business effects, that can have insurance effects, that can have financial effects that reverberate throughout the world. It's not just us. We don't do this in a vacuum. And so I worry about if we look too much like a cowboy with not caring about what the rest of the world cares about in terms of money laundering, do we end up punished?
So
that's what I'm worried about.
Bob, let me ask in that context, if I may. So, I mean, it's one thing if we're backing off on some of this and it creates just some kind of an additional risk because we're not as tight on it. But does it even go to the point of being an invitation to go ahead and come, do business in the U.S. some other way where we didn't have before, that we're going to see even more of it now because it is lax, right? It's more of an invitation or I suppose as well, because they're seeing that we, at least right now, we're not as tight as we used to be. Does that make sense?
When everybody says that team practice is important to us, we need to get our act together. We got to run some plays. You got to know if we call play 4, this is what you're going to do. And by the way, Duke is in the Final Four, so I'm very happy. Okay.
Okay.
So if everybody agrees that practice is important, and you end up with one guy on your team saying, "Dude, I'm a superstar. I'm Cooper Flag. I'll show up at the game, and I'm going to do just great. See you guys later." Well, that's possible. That's doable, but you've kind of screwed up the entire dynamic of what it is to have a culture and a team, and I worry about that. It's something to pay attention to. These decisions that the Fed is making right now are not done in a vacuum. Believe me, everybody in Europe went, "What? You're not going to..." We all disclose. England and Wales, we all disclose everything, and you're saying you don't have to. I guess you're just not showing up to practice. That's what's happening right now.
Okay. I'm going to pull on that because I like this thread a lot. So I've lived in a couple different states, Texas, Oregon, Washington. Some of those states are wide open. You know, your records are publicly available regardless. And let's just talk about land ownership, right? So in Oregon, I could go pull records and see who has owned every piece of property. What, you know, as far as a corporate entity, I can't necessarily go deeper into this, which BOI was supposed to solve for. And unintended consequences of that is, man, as a property owner, I felt pretty wide open because I got a lot of personalized mail that I wasn't sure if it was fraudulent or not. And until I got in this marketplace and I started learning about these, UDA app, unfair deceptive acts and practices when it comes to advertising and reg in and all those things, I was like, this is weird. Like, oh no, gosh, I'm behind on my bill. Well, they had all the information because all I had to do was go to the title company and pay $5 and get a whole list of stuff. Whereas down in Texas, and they're like, well, you own this property. We don't know what you used to buy it or how much you paid for it, but we can make some assumptions based on when you purchased it. I bring all that up to say, I'm going to call back to Duke. Let's talk about Cooper Flag for a second. NIL hits the wavelengths in 2000, right? Name, identity, and likeness rule for NCAA. All of a sudden, college players can get paid, right, compensated for usage or using their NIL, their name, identity, and likeness. And so what has happened since then, I think, is a good example of what you're talking about with the BOI. All of a sudden, you get these booster clubs putting together 501c3s that are cooperatives, spending millions of dollars, Duke, and putting into paying these players, and mostly in the football, the top 25, 23 of them were football players, I get it. But they're paying a lot of money under a 501c3. You don't know who all the people are because why? It's a 501c3, and all these players that were receiving, $6 to $8 million as a college player have to go do some charity work that year. Now, I understand that's changing next year, but that was an unintended consequence of something meant to do pretty good information. I think if we're trying to say, hey, foreign entities, we want you to come invest back in America, and by the way, you can invest in America, and we don't have this BOI thing because when you become a local company, it's like, hey, come on in, the restrictions are a little less, but the unintended consequence, to your point, Bob, is money laundering. NIL was set up to help benefit a college student whose likeness was being used on, video games, not Madden, but video games and TV shows. And like, wow, you made all this money off Cooper Flag dunking, as a 6'8" freshman on Duke, and you got these posters, and he didn't make anything. So good reason, poor outcome, or an outcome that was then quickly pivoted to the benefit of corporations.
Well, let me tie it up real quick. What I'm hearing is it was likely Russian money that got Duke into the Final Four. Is that what we're saying? I'm sorry. I'm trying to connect it. I'm kidding. I'm kidding.
You did a great job tying everything together, but I think you just stretched it a little bit, right?
Right.
Yeah. We've been to that story before, Ray. I'll take
Mom,
it.
I'm on a video. Mom, out. I'm recording, Mom. Out.
Okay, that was terrific. That stays. Okay.
That'll always be there.
Okay,
but you know what I'm saying, Bob?
Nathan,
like the unintended consequences, and I'm with you on the BOI.
You raise a great point, and let me say, when I spent a couple hours just yesterday reading this report on everybody's international efforts to combat money laundering and the beneficial ownership information that all these countries are collecting, and what you're identifying very well is you collect it, But then who do you give access to it? And how could they scam you because they know things about you? Nobody wants that. And so what this article was pointing out, I'll send it to everybody. I can give it to you. So we got a link here. The nations all differ. They all, like I mentioned, France needs you to pay for it. England and Wales are going to let you see it for free. Everybody's got different rules. Maybe only law enforcement gets it. Maybe with a subpoena gets it. But at least you know it. And so all these nations have different gatekeepers on the information.
Okay.
Everybody's, except us, really, seriously, it's us and China. Everybody is willing to say we need to know who buys property, and then the gatekeepers is where everybody's differing. Do you pay me? Is it law enforcement? Is it private party? Who can get a look at owns this property? And again, I'm tickled by the fact that Australia and we are blood brothers on this. We're not doing a good job.
All right, so call me through on this one then. Like walk the line. How does BOI enhance or reduce the enforceability of the USA Patriot Act? Because the USA Patriot Act is that I'm supposed to, as a financial institution, share my information with other financial institutions and the federal enforcement agencies likewise, right?
So you're talking about
identity
section
being key.
314 of the Patriot Act. 314A says law enforcement gets to come in and get your information, and you have 14 days to respond to the feds when they want your information. 314B is a privilege between entities where they can share. If I'm investigating and I request your information under 314B, I have a privilege. I have a safe harbor. I can get it without anybody bitching about the fact that I got your NPI. Okay, so I can get your investigation, Nathan, through 314A, but you've got to elect to be a member of 314A. You have to say, okay, I'm in. I'll share my information with you, and you're entitled to go, no, I didn't elect that. I don't share information under 314B. Now, if 314A, the feds come in, you gotta share it. So that's how the Patriot Act sort of handled, hey, let's all talk to each other. They made a difference between law enforcement and private parties.
Right. So it sounds like with what you're talking about, it's selective by law enforcement as opposed to a wholesale data grab of information that we or somebody can reach into. So we have to be more proactive to get the information under Patriot Act versus if we're looking at BOI, we were talking about we're collecting information and it's just this database there if we need it when we get it. Does that make sense?
Yeah.
Yeah.
Yeah. It's just a lot of high end real estate. This article, Paris-based organization, starts off and says real estate has a money laundering problem, and it still is a central place to go to launder. I mean, how many car washes did Walt need to do in Breaking Bad to clear $1 million? I mean, he just, you have to do one house, but Walt had to wash a lot of cars, and so real estate is a very tempting place for people to go, hey, here's $3.5 million. We're gonna buy this house, and 2 years from now we'll sell it somewhere else, and that's cleaned money.
It is tempting, and it is. I think it doesn't hurt to see. But here's a data set. So Greg, here we go. Well, you get more HMDA data. I want to know how many purchase transactions were done in primarily cash with 50% or less LTVs. Right. I'm curious because that will actually give us a little bit of a takeaway to say, okay, how many houses does an entity have to set up as an LLC that they're going to purchase at what marketplace, right? 70% LTV to get some pretty good DSCR rates and cycles, right? Debt service coverage ratios, which are outside the non-QM. They're privately held. You're probably not going to see a lot of them on the HMDA data. Wait, do you, Greg? Do you see DSCR in HMDA?
No, you don't. And you don't see cash transactions either.
Yes,
Okay.
but it could be partial.
So-
You could be, but we can get lower
You
LTV.
get partial.
Yeah, you get partial, right?
Yeah.
So it's low LTV transactions most likely, even though that could be a number of reasons. That's going to be your folks in
See?
California retiring into Texas, right? That's and I know you're in Texas, so you're like, yes, I see that every day, and me being from California, I get the bumper sticker that when I drive in Texas, said, yes, I'm from California. Get lots of friends that way, but
You're number one, man. You're number one.
So yeah, exactly. I'm number one. I get a lot of those. But yeah, I think that would be interesting to see how we can look at the data. Greg, I want to talk to you about. We'll play with the data in that context. I'd be kind of curious to see how that works out.
Well, the industry has some ideas about this. When you focus on the data landscape, you look at the open data, the government goes through some hoops to protect privacy. We think sometimes they go too far because some of this stuff is the cat's out of the bag, and we're not getting data that would be otherwise helpful towards broader transparency and competitive intel and fair lending and all of that we wish we had. But they're cautious about this. But there's a system there, Bob, to what you're describing, where a data set like, well, you take the American Community Survey, the census, the big annual statistical survey that the census does every year, Census Bureau, or HMDA itself, where the government's collecting more data than they're releasing publicly for this very concern. So I think when an open data set becomes mature, you can have tiers like that perhaps could be part of the solution to what you're describing.
Well, all right. Ray, I'm curious on your take. Loan risk advisors, I love talking to you about random things within the dialogue of risk. So talk to us a little bit. Like, where do you see us getting into greater risk levels or tolerances here? Anything that you can pull from fair lending, from other regs and structures?
Well, yeah. I mean, there's a lot. I'm not going to rehash. We know a lot of changes on the regulatory landscape at the federal level. And we've talked about that before. A lot of people have talked about it simply because the example, probably the top one there we talk about is CFPB and how that landscape of that agency is shifting. Regardless, I think, regardless of what they do with funding, not funding, you have to keep the employees, don't keep the employees. We have statutory services and statutory acts and services we must provide under Congress's act under Dodd-Frank. So whatever the structure is, I think it's still going to be there. But still, if the mission is to pull back what they do, and I'm going to put it this way, maybe they perceive it as, number one, operate at a lower cost, number two, let people do a few things and innovate. I think that no matter what's going to happen, I think that's going to be the personality, the character of the CFPB going forward for the next 3 years, whatever minimum, right? So I think, to answer your question, we've talked about this many times and people have, and that is that there's going to be, you can look at it either less oversight or more collaboration, however you want to classify it. So I think there's going to be changes, but what I want to be thoughtful about it. We still believe, I think, in many cases, in those in the compliance professionals, attorneys like myself or others, I believe we still have the laws and regulations. We still need regulations. We still could use some oversight, more in a collaborative sense, to make sure we're operating within the rails and the expectations of the regulations. So it isn't as if we want to go completely Wild West, and you can't anyway, but Wild West and do what we want to do. But again, we see demonstrations of how the messaging from the administration is pulling back a lot. And the latest one that I noticed was where the appraisal rules by the CFPB have been pulled back and canceled in all intents and purposes. And that is, if you recall, there was a movement where appraisals were starting. There was a possible realization that appraisals in and of itself had some bias within it based on things that would violate fair housing, et cetera. Now, it wasn't always blatant, but this was again, as a matter of practice, is what they were looking into. Rules were established for consumers to be able to challenge their appraisal. So in the event that they thought, my property should be higher, and for sake of discussion, I'm in a minority MSA, or I am a minority, and for sake of discussion, the appraiser they observed was not a minority, did that have an effect on my value? That's really the underlying question, and what do we do about it? So the CFPB came in and established some rules about how appraisers should behave, how consumers have rights to challenge an appraisal, and basically almost with no cost. And that even mortgage lenders had to be policing more for any bias within the appraisals. And we touched the appraisals, right? the underwriters are going to look at them. So those are the things that was intended to go into. I don't know where to land on this, right? I have my opinion. It doesn't matter. I'm talking about the framework of how regulatory, the regulatory character and personality at the federal level has changed. And this being the most recent example, this is pulling away that no longer applies. But it does raise the question. I mean, some of it was when you're talking about appraisals, keep in mind, and this is the frustration with lenders who were in the crosshairs before they finalize these rules. As a matter of litigation, lenders were in the crosshairs for appraisal violations or perceived or alleged appraisal violations violating fair housing or ECOA. And at the same time, remember, the lenders, based on Regulation Z, we're not supposed to be talking or controlling with appraisers to begin with. So they're independent. So how could I have influenced it? What was I supposed to do? Am I supposed to now insert myself into an appraisal where I thought the other law says I can't? So there's confusion is what we dealt with. Plus, at the same time, appraisers generally, and Greg, you're definitely a scientist on the data. The perception I typically have is an appraiser works off of a model, and that's how you evaluate things. And yes, you might check to see if they got it right. Was the house that they're using for a comp on, which side, what quality neighborhood was it? Is it equal or is it not equal, right? Insofar as creating the comparison value method for valuation. So it was still the data would support whether it was fair or not, or whether it was proper or not. Now, there are also comments sometimes you can put in appraisals that could be controversial. But again, at the same time, it is a science. It's not as much an art. That's what I think, right? I took my undergrad, of course, is real estate finance, and I had to do appraisals. So theoretically, as a model to how you would evaluate, someone can challenge that, but the model is pretty well set. So we didn't think that there would be appraiser bias that would impact fair lending for that matter. Now, as you go on, you learn things. It doesn't mean we can't do things better as lenders. So the way I look at it, even if the rule goes away, we still should be thoughtful to make sure the appraisal makes sense. We always have. We've always looked at it, and Nathan, you've been in this business a long, long time. You look at the appraisal, and was the comp correct? Did they actually value this correctly for the view? For all I know, right? There's a method behind valuation. Mm-hmm. So by pulling this away, I'm wondering what the impact is going to be and the concerns that they have. I do believe there were instances of issues that bubbled up. The question is, was it big enough that we had to get a final rule in place? So at the end of the day, pulling back the rule, maybe is helpful for the industry because it was kind of a crosshairs of I can't really get involved in the appraisal, but now I need to be. Is that really fair? How does that work? And of course, to administer compliance is very expensive. And what ills are we trying to fix? Was there a lot of discrimination and by numbers and by volume or not? So again, did we try to overfix it? But I've always said, and I continue to say this, as compliance professionals, we are stewards of the law and regulations, regardless if there is a regulator. So we still have to be thoughtful to make sure that we should look at the appraisals and make sure that they're balanced. So don't abandon the idea that this is no longer our problem. We should always look out for fair lending. And I'm curious to see what we do with, again, appraisers. And now that we're aware of it more, do we pull back on it completely, or do we still have the diligence? Should we still have the diligence to challenge appraisals from a fair lending perspective? But anyway, I'm just giving an example of another thing that had popped up and how the landscape is changing and how I'm reminding the industry, just because they pull back doesn't mean we got to pull back that much. We still have responsibility.
Let me ask you a question of Nathan. You're an originator, and talk a little bit about the ordering of appraisals, values coming in a little off, the interaction with appraisers, the interaction with your clients when values are just a little off, say, because it raises customer service issues, and it can raise some ethical issues as well. And I would just comment that we live in if you were about to buy $500,000 worth of stock, and an appraiser told you it was only not worth $500,000, it was worth $400,000, you would say, thank you, I am not buying that stock, and you would walk away. But that's not what we do with real estate. If the appraiser is coming in low, the borrower argues and says, no, it's really worth more. Let me pay more. Ethically, What do you do as an originator when you're dealing with appraisers that should be arm's length and your borrowers?
It's a fun question, right? Because even to your analogy right there, yeah, I don't want to spin it, but stock doesn't put, a roof over my head when it rains right away, right? So people are looking at safety and shelter, Maslow's hierarchy of needs, and so they see their safety and shelter, and they're like, well, I want to buy that. And I want to buy it, and don't tell me it's worth less or worth less than what I want, unless you're the buyer. That's where the rub comes. Like I get people who are like, I'm going to offer 35,000 less, and let's just hope for an appraiser for 50,000 more than it's listed for. You're like, why? Well, because I feel better about my choice. Like that's what the buyer's looking for. Then when you get into a competitive marketplace that you're talking about, like we order, and so we order through AMCs, appraisal management companies, right? There's no direct one-to-one correlation with the appraiser at all. It's like the lender, I'm a broker, and so the lender makes the order through, or we make the order through the lender, the AMC. We don't know who's going to be attached to it. We might have a good idea if we do a lot of loans in a certain area because there's only a handful of appraisers, and if you see their name come across, you might be like, oh, okay, I know what we're getting prepped for. And so appraisers have history, and you know kind of what you're going to get in their reports, especially in some areas of Texas and Oklahoma that we're in. There's not a lot of people to choose from. And so you see that happen, but we can't contact them. Error stands. Appraisal independence requirements, they hit. So say you have an appraisal come in low. They've already got their offer and they need seller concessions, and the buyer's like, I'm ready for this, and it's 300,000. The appraisal comes in at 280, and you're like, what in the world? Well, the cool thing that I've been running into more in the last couple of years is that AMCs are more likely to adopt some of what we're seeing happen in the VA loan, right? So you get a VA loan, appraisal comes in low. What do you have? You got Tidewater. Number one step, go back. The appraisers has to let you know before the issue value, hey, here's what's happening. We're not going to meet your value. And so what you got to do is work with your agents, get a couple more comps. You don't know what they're using. You're going to provide some comps. You don't want to use all your comps because you got to save a couple just in case. But you want to get those comps back over the appraiser and say, hey, did you consider these? This is where we think the value is coming in at. And if the appraiser ends up going with whatever they go with, they're going to send the appraisal in. Your lapsar at the lender is going to go over that. They're going to issue value. They're going to say, hey, here's what the valuation is. But you still have an RLC. You can go for a reconsideration of value with the regional loan center at the VA and say, hey, the borrower, the veteran, can write a letter, say, this is why we want to buy the house for this much. This is why we think the value is fair. Here's why I wrote the offer, and put that in. And the RLC can override the appraised value as well. What I'm seeing happen outside of VA loans, AMCs are starting to adopt a more of a Tidewater mentality. Hey, we're not going to hit value. Do you have any other comps you'd like to offer before our appraiser gives us value? Yes or no, right? And you can come in and say, hey, here's why the real estate agents have made the value play they did on this one. But to your point, what's it driving towards, right? Is it driving us to over index on the margins of the property? Is it driving us? Well, competitive natures do create a supply and demand issue. We have a lot of demand. We don't have enough supply, even in these interest rate markets. We are going to see prices increase, hopefully not as rapidly as in the past, but you're going to see the 2, 3, 4, 5% increases year over year. It's just how many 30-year-olds are trying to start their family. Like, that's just what's driving it. And that's where we're going to see. Now, I've also had some people get their appraisal back and it's under what they wanted, and they're like, cool, I was not emotionally tied to this, so that's awesome. I'm out, right? We didn't get it. I'm going to trigger my escape clause, and thank you very much. It was $600 well spent. Well, and they walk away happy.
But Nathan, you bring up a good point, where and it's the reconsideration of value, right? That process, which the final rule kind of solidified and required, right? Pretty much. And right now, no one's really required to do it. It's nice to hear that the AMCs are taking it upon themselves, and maybe it was because of the final rule, but they're taking it upon themselves, and they should continue to do that. So, I go back to, I don't need a final rule to tell me what I need to do for every single appraisal. That being said, we're all required to be responsible in what we do. So, using Greg's a term that he often uses when it comes to, what's the problem and how did this get triggered? Some things are not monocausal. I love that, right? It's not a single thing that caused it. So when you look at an appraisal, it could be a number. There's a lot of moving parts. So whether the comp was correct, whether it was in the right neighborhood, or whether, to do the right valuation against it, or that is too old, or whatever it is. So there's a number of things that go into creating the value that make it difficult to isolate that maybe there was a little bit of bias as well. So, and bias shouldn't be coming into the analysis, and that's what they're trying to protect. My big thing is I don't know how big of a problem it really was if we believe that appraisals are based on a model that can otherwise be relatively easily challenged. It just doesn't. This comp doesn't make sense. This doesn't make sense. Why did you come up and low? Well, because it was in this neighborhood. Okay, that you can't do. So I've always thought there was a little bit more objective. There's a lot of objectivity rather than subjectivity in appraisal methodology. So,
Well,
Greg,
that's the irony.
Yeah,
go ahead.
No, sorry.
No, Greg, your turn.
Yeah, that's the irony of taking an approach like AVMs to the question of valuation, is that, and this is true more broadly of a lot of different data science models or machine learning models, you're doing something in order to take bias and subjectivity out of the question. You think if human error is out of the picture, we can take a consistent approach and solve this problem. But something is lurking there that's known in the industry as the alignment problem, and that is that sometimes models don't do what we think they're doing. Sometimes they don't do what we think we're telling them to do. And so I think to your point, to the context in which you're bringing this up, Ray, it's a continual process where I think everybody, all players, all stakeholders have to continue to weigh in on this and look at the problem from different angles, which in data science terms means continuing to refine your models, build different models. It's not just a single model. And we know that some appraisals are done in person, some are done in an automated fashion. You can just, and we like to think about this even in the HMDA data, reason with the data, know what the property values are. For every mortgage transaction you can see in the HMDA data, 6 million in 2024, 6 million plus, see what happened recently. And that's not that itself is not a model, but it's an input to the person thinking about the problem and understanding what's going on.
I was only going to add that in human error, humans always have a bias. We always have a bias. I'm biased to colors. I'm biased to like green versus blue, to Stratocaster, like guitars behind Bob, right? I like guitars too. I'm biased to what brand he's got. And so I can see where the more we can take the human bias out of it, the more we can have a counterpoint positioned before the final value is given, the more we should have a good conflict in such a way that we come to a common ground in an issuance of value. I think that'll help to Bob's point, like customer service wise. Well, this was reviewed by, and that we were given a counterpoint. And so a customer can, hey, my voice was heard. This is good. I feel like I've been heard and they still came to the value. I'm mad about it, but okay, great. I'm going to move on to the next thing. The only takeaway there is I prefer seeing more automated value systems, because like how easy is it to come up with a set of value structure of square footage, what's trending on the market, how many square feet you have, how many beds, baths, windows, like all of this is known to a large degree. How many feet are you away from a fire hydrant, a bus stop, and a public library? I mean, and I could see, I live on acreage out in the quote unquote country of Texas, and not really that far from I'm 15 minutes from Target, right? That's a really simplified way to say that's my value proposition. But my neighbors are 500 feet away on both sides. So if I get an appraiser out here to look at my property, he's like, man, I prefer in town. I don't like driving this far. He's already maybe not feeling great about my property. And when he starts doing his math, he's like, I wish it wasn't. Or maybe I have a appraiser and she comes out and she's like, it is my dream to live out there. This is priceless to me. And she gives me an extra 50 grand just because she didn't have to look at my neighbor's house. How do we stop that? Well, that's not even bad bias.
I suppose, Nathan, but the one thing, and Greg, you kind of talked to maybe about the concept of alignment as well, is if we go to something that is more objective, and by virtue we're talking here not human involvement. The data set that, and this is I want to say ironically an old AI argument, because AI is not that old, but we know this. It's only as good as the data set. So if the data set was already compromised because the valuation, even at 1,200 square feet with 4 bedrooms, was based on where it was located or what MSA, and now we put that into the system, either as machine or with generative AI actually learns maybe even worse, we don't know, but it's starting to learn the fact that for whatever reason that we can't account for, and now we can't account for it in the AI result, is for some reason MSA is coming out a little bit lower. We don't know why. Gee, I guess it's actually 1,150 and not 1,200 square feet. That's not it. So we still have to be thoughtful about that. I mean, I only say that because we all know that, but for the sake of discussion and that we put a pin on it here, we know that with automated objectivity becomes the question of the subjectivity that came from the data set to begin with. So we're going to suffer from that. AVMs being, I think, one of the things in the crosshairs, at least I wouldn't say old school, but we've been using AVMs longer than we use the word AI. That maybe is coming across here. So, I don't want to bring up here that with this removal of the final rule, we're going to have all kinds of fair lending problems. I also want to suggest, however, and as we discussed here, while I don't know how widespread the issue was, none of us have been able to dispel the fact that there is no issue at all. So we have to kind of be thoughtful about that and monitor it. And this is where people like Greg, this is where we might see it. We might see in valuations or something in the data at some point, right, Greg?
I'll add my version of the bookend to say a George Box, famous data science quote, a George Box quote, all models are wrong, but some are useful. So we have to keep improving our models, keep making sure they have enough attributes, like some of the attributes you were calling out, Nathan. That's like, think about a spreadsheet, not enough columns to approximate or approach what's really going on in the real world. Just have a few data points maybe, or not enough rows, not enough comps, so to speak. Maybe your training data isn't big enough. So we have to ask these questions and kind of knead the dough on that to make it better and better.
Well, and we know that value is what somebody chooses to pay for something, right? Yeah. Value is both what is at risk of being traded. And to Bob's point, I would say that if my appraisal is coming under and I still want to do it, I'm just short on cash. I'm just going to put a 60-day pause on this, deposit some cash from the local drug dealer into my bank, let it season for a few minutes, pull my new bank statements, and I'm good. I'm golden. I'm outside the 60-day windows, and nobody's going to ask for longer than 2 months for me.
Actually, Nathan, from what I understand from your perspective, you can borrow the money from some college player that's just sitting there anyway out of a nonprofit that was funded by some illegal company. That you can try.
100%. Yeah. I think we're coming on to a new one right there. But I'll bookend that with my other favorite quote, which I think applies here from Mark Twain. It's not what we don't know that gets us into trouble. It's what we know for sure that just ain't so.
Mm. This is exactly true.
Yeah. Bob, any last thoughts, takeaways, sir?
That's a good quote, and at my age, I'm not sure I know a lot. I do more listening now.
I love it. All right, gentlemen, it was a fun topics. I'm just gonna play around with the title on this one. I think is something about like values and who in the heck owns what. That's what I'm thinking this one is all about, like where we come from. So thanks for listening. If you listen this far, ladies and gentlemen, to the Risk and Roll podcast, you have Ray Snytsheuvel with Loan Risk Advisors. Find out more information about him in the show notes. Bob Simpson with DaylightAML. Look, if you want training that's better than the boring point and click stuff, you need to talk to Bob. Get your board trained too, because that's a massive risk that then Ray would tell you has some pretty hefty fines associated with it. And then if you got data and you want to make your data look pretty and understand exactly what's behind it, Greg and his team at Polygon Research are the people to talk to, because they make all the boring HMDA data in the world actually actionable for your business. And then I'm Nathan Oliven with MLO Force, where we just want to be better trainers to an industry that deserves the best. So thanks, y'all. Thanks for hanging out with us. Wait, what do you got, Ray?
Well, my mom came in, which just kind of ruined my street cred, right? It's kind of like playing video games, and your mom comes in and says, take out the trash. Well, she came in, she dropped off the cookies. That being said, these are great cookies, so I'm glad she barged in.
I like it.
Crazy. All right, y'all. Have a good one. Thanks for being here.
Thank you all.
Take care. Thanks, everyone.